So I want to jump right in and tell you about the work that I did with my co-author, Ann Tucker, and it is about, as the title indicates, ESG investing. So, of course, that is a reference to investments that use environmental, social, and governance criteria in portfolio composition and management. And as I'm sure you are mostly aware, the field is really exploding. In fact, it's continued to expand enormously since Anne and I, Professor Tucker and I, began our work in this area in 2018. ESG funds had their best year ever in 2020, and I'm sure many of you have heard reports about how ESG funds outperformed many conventional funds during the tumultuous 2020 market year. So let's see, maybe I can even run my slides. Yeah, so this is just some of the information about the growth of the market. The trend is also very much in favor of passively managed funds. That's been accelerating. So we see kind of a convergence of this trend in ESG and a convergence in passive management, and also expanding. Part of the story that we wanted to look into was, really, is this too good to be true, right? Are we really, we're naturally skeptical academics to ask whether what we're seeing is what we should believe. And so we were wondering, are these funds, do good for investors' pocketbook, really too good to be true? And so we started investigating in ESG investing in the mutual fund and ETF space. And one of the first things we found is that ESG investing has just become so much more sophisticated, right? So we have a history of using negative screens in sustainable investing. Those are still used in some funds, but a much more of the growth seems to be fueled by adoption of positive approaches, screening in high ESG performers. We noticed that there are a variety of these techniques. Sometimes you see an ESG fund that considers ESG factors of management. Sometimes they seek out ESG leaders across various categories. Sometimes we see an ESG related theme like renewable energy. And our look at ESG also embraces the concept of engagement, whereby funds are going to use their power as shareholders to drive ESG improvement at investee firms. So after working through these various techniques, perhaps you can advance the slides for me, or no. Seems like that's making it challenging for my connection. So what we wanted to do was to dig into, well, what are these funds actually doing? And particularly, how are their actions different from the actions of other conventional funds that might be comparable? So before I go into the details of our study, I think it's worth mentioning, and you can move to the next slide after this growth and after the history slide. One more. Right. So I think, back one. I think it's worth noting that the ESG phenomenon is often kind of superficially thought of as being about demand, right? That investors might be demanding more sustainable investing options, and so that's why we would see this increase in fund flow, as well as an increase in the number of funds. But our intuition, and we certainly found evidence of this in our work, is that supply is also a really an important driver here. And so we want to think about why mutual fund and ETF providers, as well as those who are developing the metrics that are the the foundation of ESG passive funds, how are those actors kind of creating the or contributing to the expansion of this market? We see fund families are competing in a crowded and demanding investment management market. They're trying to maximize their profits through a combination of revenues from fees and otherwise, and for market share. And we see ESG investing as a strategy to bolster both of these. So going back, of course, to the mounting evidence that ESG performance impacts financial performance positively, fund families will see these funds as potential financial winners for their investors and therefore for themselves. And we've got demographic changes on board that mean this is a way to help them increase market share. But we also see the ESG fund phenomenon as a strategic counter to the rise in passive investing. It's true that ESG passive is growing substantially, but there's still a very large chunk of the ESG market that is actively managed. And actively managed funds in other areas are disappearing fast. And this is a place where fund families can continue to generate active management fees and justify them because of the additional informational requirements that are necessary to operate in the ESG space. It's a kind of active management strategy that investors will still pay for to some degree. That, of course, is continuing to slip as the efforts of the metric providers and index providers continue to come on board. And so, of course, that power of those index and metric providers is very important to this story. They have their own business interest in the ESG investing market. Fund families are relying heavily on the research capacity and benchmarking tools and indexes provided by this massively growing industry. So we think thinking through these supply side drivers is really important to understand what the funds are doing. Okay, next slide. So this is a description of the funds that we studied. We looked at 38 mutual funds and ETFs across 3 different categories. We started by creating an ESG fund list using a combination of assets under management and annual returns for ESG funds, along with the Morningstar sustainability ratings, which generated this list of 20 ESG funds. We added 11 ESG passive funds from a Morningstar report on U.S. passive sustainable funds. And I should say our study is on U.S. For this audience. Obviously, that's critical information. So we took 3 funds from the ESG funds that we identified, which were in fact passive, and together with the additional 11 funds, we had 14 in that panel. And then we identified 7 comparator funds that were offered by one of our fund families that offered one of our ESG or ESG passive funds. We looked for a comparable fund from that same family that seemed to have the same strategy, but didn't include the ESG component. Okay, next slide. So then we investigated these funds across these 5 points of comparison: investment strategy, fees, portfolio holdings, voting records, and tracking errors. So I can we can go to the next slide and I can walk you through our findings. So on investment strategy, the biggest thing that our biggest finding was really variation, right? We were looking at the investment strategies reported in the fund's summary prospectus that is filed with the SEC. And they did typically mention something about ESG, while our comparator funds did not. But the most interesting finding was tremendous variation in investment strategy across the ESG funds. They varied a great deal in how much they said about how they would use ESG factors, as well as what they said about it. A few said nothing, but most said something about the range of their activities, and the types of disclosures were extremely variable. So this confirmed our sense that the variation in the ESG market really requires a lot from investors who are trying to distinguish between ESG investment offerings and identify the appropriate ESG strategy and outcome for their particular investing goals. We also believe this opacity is empowering for fund managers and index providers in ways that are difficult for investors as well as regulators and other stakeholders to perceive. So then our next cut, you can go to the next slide, was to look at engagement, right? And here we can't know what fund managers communicate informally with their investee firms, but we can get their voting records from the SEC filings, which is what we did. This is an extremely arduous task, and the reason this research has not been updated is because I'm working on another book right now on another topic, and this is a basically manual process, and so doing this research took at least a year, and we are hoping to update it in the future, but haven't passed these details you have here. So in the next slide, what we did was develop a series of charts that are in our paper reporting selected votes for kind of demonstrative environmental, social, or governance issues. We picked one for each of those categories. For environmental, we looked at climate change proposals. For social, we looked at gender and diversity proposals. And for governance, we looked at proposals on political spending. So these are proposals that shareholders put before the annual meeting of the corporation, and we looked at how these fund managers voted on those proposals. And it's hard to show all of this here, but it's really a mixed bag. And we did also review other arguably ESG votes among the top 10 portfolio companies. So you can think about each of these funds has many, many companies in which they're invested, and that's what's being reported in these charts. We also, in some additional research that I don't have a chart for here today, we also looked at the top 10 investee companies for each fund manager, right, for each fund, and try to look broadly, at other kinds of proposals to see if that would give us more information. It did give us more information, but not more consistency. So there's a long discussion in the paper of some of the possible reasons for this kind of considerable amount of variation. You can move to the next slide. But two of the most interesting stories, I think, are these. One, which has been written about in the investment literature here in the US, is that fund families often vote as a block. So you can look at the first line on this chart, the Vanguard FTSE Social Index. They vote against the E, the S, and the G proposals in these years that we were looking at the data for. But this also is consistent with a story that Vanguard, the company, votes all of its shares in that way. And the ESG fund votes that are Vanguard ESG funds are really just an artifact of that effect, right? So if they're trying to make consistent decisions for the whole company, right, about how to vote rather than fund by fund, then you're going to see voting in ESG funds that might not necessarily match up with your expectations for an ESG focused fund if those decisions are being made at the fund family level. This might be harder to do under some new SEC guidance on voting by asset managers. We're still waiting to see how that shakes out. The second story, and you can go to the next slide, that you might take from this is really a story about convergence, right? Because if you look at these voting records, which are from our non-ESG comparator funds, they also show a considerable amount of support for E, S, and G proposals. And so maybe what we're really seeing is that ESG funds, like other funds, are chasing financial return, which is increasingly correlated with ESG performance. So next slide, we look at another area of comparison, which is, well, what kinds of investments are these companies, are these funds actually holding, right? What companies are they investing in? So you can see in the next slide that we look at the top portfolio holdings, and we put them in kind of buckets, right? So what industries are their top 10 portfolio holdings in each of these funds in our study? And these charts are kind of an attempt to unpack this kind of category. Like, are there industries where you see ESG funds and you don't see non-ESG funds, right? That would be a qualitative difference in what you're getting if you're investing in an ESG fund. And again, it's not that different, right? You do see the other category in non-ESG funds is made up of different kinds of companies than the other companies in the ESG funds. Those kind of in the blue boxes here which are pretty prevalent in all three funds, and the top type of company in the ESG passive and the non-ESG comparator groups. But in the non-ESG comparator group, you see a lot of traditional energy companies in that category, which are largely absent from the ESG funds. You also see a lot of specialized funds when some of our ESG funds in our ESG bucket are specialized funds themed right around a particular ESG issues. And those kind of create a prevalence for companies that you just don't find in some of the traditional funds, but not overwhelmingly so. What we're finding is that we're talking about mutual funds here, mutual funds and ETFs that are offered by, large fund complexes, and they're more similar to each other than they are different. They overwhelmingly invest in big companies, particularly in household names. And the paper reports some more information I don't have in these slides about the prevalence of kind of household name companies in terms of the investments. So again, it doesn't look that much different. It might be, again, a story about convergence. Okay, next slide. We also looked at fees, right? Fees matter a lot in the fund space. And this slide reports some of our findings. There are more in the paper. But the upshot is there's a lot of variation across ESG funds. Although passive ESG funds do charge lower fees than those using active strategies, which is not surprising. We also find that the fees in ESG funds are higher than your average ESG, non-ESG funds, right? So the fees are higher, you're paying for this product. And these findings comport with other studies of ESG fees. And those also point to the increment for, even for passive funds, that is a higher price point for an ESG passive than a passive fund that's not including the ESG component. Our final point of comparison was tracking error. You can see this on the next slide. This is the extent to which funds differ from those of a fund differs from the index that it tracks, right? So this is only relevant for passive, right, where they're tracking an index. And tracking error says, well, how different are the holdings in the particular fund we're looking at or set of funds from the indexes that they're attempting to replicate. ESG funds do have higher than average tracking error records across our study. But it's important to notice that tracking error is not always bad, right? It's just telling you how much the difference is. And it can be explained in a lot of different ways, including maybe an effort to pursue even greater ESG excellence, right? So we don't necessarily know that the divergence from the index is a negative. In ESG funds where tracking error is relatively high, investors won't get as close to what the index promises as they might have hoped, but we don't really know that that's a bad thing, and we don't know how reliable the indexes are in the first place. So in the end, our study suggests that, and you can go to the next slide, our study suggests that rather than a clear investment strategy or some kind of new asset class, ESG is mostly operating, again, here in our US market for mutual funds and ETFs as branding or some kind of market signal that a fund is in some way normatively good, and that's not easy for investors to unpack. And so the last slide, at the very end of the paper, we suggest some avenues by which the law might contribute to increasing the consistency and decreasing the opacity of this ESG fund market. And this is, in addition to updating the data with new annual disclosures, these are the paths that we're looking to explore in future research, and I think really connect with what you're going to hear from Professor Colaert. The first idea that we endorse is improving fund disclosures around these issues, which could happen through market forces or be prodded by regulatory requirements as you have in the European context. And there are some proposals for greater ESG disclosure that are getting some action in the US, and probably more so now under the Biden administration than certainly under our prior administration. but most of those have operated really at the company level. And we argue that fund level disclosure would be much more valuable for investors, because investors in our market very rarely invest in individual companies. And so requiring disclosures at the fund level, we think, would be a more effective way to help get the information to investment consumers. We also call for the regulation of intermediaries. Particularly, we're interested in the pension context here in the US, which is regulated under our ERISA law by the Department of Labor. There's been pretty negative guidance coming from the Trump administration Department of Labor on these issues, but we expect much more positive guidance on this now to open up the greater ability for pension investors, to particularly defined benefit pension investors, to take advantage of ESG funds. And if that market opens up, we think that those intermediaries can be regulated in a way that would then push back on fund providers to really require greater and more consistent disclosures, so that the pension managers are able to comply with their own obligations. So we think that's a fruitful area for future reform. And then finally, we really believe it's very important to start regulating the index providers, those who are generating the metrics in this area. They often provide indexes that are used to guide the investments of a single fund, yet they're not regulated under our law as investment advisors or fund managers. They're treated almost like publishers, right? That they're just, putting out information, and, we're not telling investors what to do. But we think it's really important to, in a more granular way, regulate the index provider industry. And this issue, of course, is not limited to the ESG area, but is prevalent across investing and is really ripe for review and reconsideration. So that's where we are now and where we're looking to explore in the future. And we are so very much students of Europe, because you all have gone so much further in this direction than we have in the US. And so I look forward to learning from your comments and contributions.
Yeah.
Okay, thank you very much, Professor Brakman. I'm not sure whether we should take questions now or at the end of the session. Perhaps because we started a bit later, we should first have Professor Colaert give an overview of the European financial regulation and then take questions after that presentation. Okay, then I'll quickly share the slides.
Thank you, Arnaud. And I would like to start by thanking both you, Arnaud, and Jutta for setting up this series of seminars. So this is organized by PhD students of our faculty who are just very interested in learning how lawyers can contribute to creating a more sustainable world throughout different areas of the law. And so I'm very honored to be invited as a speaker on your first session and to have the opportunity to respond to Professor Brakman's presentation and her very important empirical research, because I think this is indeed probably the first extensive piece of evidence of what many scholars suspect but have no evidence of, that ESG is not only a very diverse label covering very different sorts of sustainability, but worse, that it is not always a true label. So as Professor Brakman already announced, in the EU, we indeed have already more regulation than in the US, but then the question arises whether and to what extent this regulation actually solves the problem. So I will give you a quick overview because there's a lot. I'll see where I can take control on the slides. Yes. So I would like to start by seeing where we come from. And indeed, I think it's very important to see that since 2018 in the EU, sustainable finance has been added as a fully fledged goal of financial regulation in the EU. before, as you know, the traditional goals of financial regulation are ensuring market stability, creating market integrity, and making sure that consumers of financial services are protected. But new since 2018 is sustainable financing as a separate goal of EU financial regulation. Where do we come from? This has not come out of nowhere. This discussion has been going on for quite a long while, already since 1992. It was first mentioned. I think it was the first mention. It is the first mention we found in a UNEP statement by banks on the environment and sustainable development. And then you see that it was reflected in the EU in the 5th Climate Action Plan, that finance could indeed contribute to a more sustainable world. But it actually set off in 2015 after the UN set its sustainable development goals and the Paris Climate Agreement was signed. And that was the signal for the EU to call together what is called a high-level expert group. A high-level expert group consisting of practitioners and professors who came up with a blueprint for reform in January 2018. The European Commission followed up very quickly on that blueprint with its Sustainable Finance Action Plan, and that has really triggered a range of reforms. The Sustainable Finance Action Plan actually puts forward two goals which are a little bit different, but both aim at a more sustainable finance and a more sustainable world. The first is to improve management of financial risks related to environmental and social challenges. So this means, as you know, in the financial sector, risk management is very important. And so the first goal of the action plan is to oblige banks, insurance firms, investment funds to also take into account ESG risks and how this has an impact on your financial situation, on financial risks. A second goal, and that is maybe the true sustainable finance goal, is much more active in trying to reorient capital flows towards sustainable investments. So the goal is to move investors from non-sustainable investors to sustainable investments. So that means, to achieve both goals, that the entire framework of European financial regulation is revised, and this is really going very quickly. So to summarize what the challenges are and what the law wants to deal with, in EU financial law wants to deal with, challenges are how to extract, measure, and provide relevant ESG information on investment. Second, how to ensure comparable ESG information for investors so that you can compare information provided by one fund to the information provided by another fund, using different terminology, having different focuses, etc. Closely related is then how to avoid greenwashing, having funds just claiming that they are doing something to provide a more sustainable world, but without any way to see whether they actually do that and whether that's sufficient. Closely related again, how can you quantify ESG risk? So in order to tackle those questions, there's a need for a standardized definition of what is a sustainable investment. And that is a first big challenge. To do that, we need to define what is environmentally sustainable, what is socially sustainable, and what is sustainable governance. So each of those elements of ESG need to be defined. We also need reliable data, and there is a need for due diligence and supervision. So where do we stand in EU law? Well, in regard of the question, what is sustainable? National labels have been developed. That means that within separate member states have developed their own label of what they think is sustainable. And that means that in all the different member states, now we have a panoply of different labels. The most successful are the French and the Belgian label. The French has more funds having the label, but the Belgian label has a bigger amount of assets with that label. So that is the SRI label, and in Belgium we have the Towards Sustainability label. Obviously, it is possible also for funds from other member states to get this label. I've put a few more labels here. There's many more of those labels. The problem is that those labels are very diverse. They put a totally different emphasis on E, S, and G. What is environmentally sustainable for one label is totally different than in another label. So that means that those labels are very diverse, very hard to compare for investors what they stand for, to understand what they stand for, and to compare different funds on the basis of different labels is impossible. So what has happened at the EU level? Well, at the EU level, the first thing which has happened, very importantly, is the idea that we should create a common taxonomy so that we know what we mean when we talk about environmentally sustainable, socially sustainable, governance sustainability. But I must say from the start that for now, the most emphasis has been given to the question, what is environmental sustainability, and much less to the S and the G. So how does this work, this taxonomy? It starts with setting out 6 environmental objectives. I've listed them here: climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, protection and restoration of biodiversity and ecosystems. Those are the definition of 6 environmental objectives. So when can an economic activity be considered environmentally sustainable? Well, to that, to be considered sustainable, environmentally sustainable, an activity should comply with 3 criteria cumulatively. First is that it should contribute substantially to one or more of the objectives I just mentioned. At the same time, it should obviously not significantly harm any of the environmental objectives. And moreover, those activities should be carried out in compliance with certain minimum safeguards. The European Commission is developing technical screening criteria of what that all means, and therefore there's a draft delegated regulation, but we won't go into the details of that. There has been a whole discussion of how broad we should see environmentally sustainable. Because, I'll briefly go back, if you would only consider environmentally sustainable those activities which actually give an active contribution to one of those objectives, that would exclude many activities which are not harmful and maybe not directly contributing, but also important. And so therefore, 2 other types of activities are also considered environmentally sustainable. The first are the transitional activities. Transitional activities are those activities for which there is at present no technologically and economically feasible low carbon alternative. Those activities can still qualify as contributing to climate change mitigations if they fulfill certain criteria. And that is actually meant to make sure that best-in-class companies can be rewarded. Because otherwise, if you would say those are not really contributing, we exclude them all, you don't give an incentive to these companies to try to do better and to have less carbon output. So that is why they are also included. And a third category are the enabling activities, which do not themselves directly contribute, but which are essential for other activities to make a substantial contribution to environmental objectives. And then we think, for instance, about companies which develop technology which is used for a windmill park, for instance. So that is also considered environmentally sustainable. Who should use this taxonomy? So as I said, this regulation is actually just giving a set of definitions. So those definitions can obviously be used by everyone. And we see already that many of the national labels are changing the content of the label to adapt to the definitions of the taxonomy. So that is a good evolution, but they're not obliged to do so. It is, however, compulsory to use the taxonomy for regulators in the member states and in the EU, but also for financial market participants that make available financial products. If they want to say something about ESG and especially about environmentally sustainable, they have to use the taxonomy in that respect. So there we will have improved comparability of what they are saying. Third, undertakings who are subject to the obligation to publish a non-financial statement or a consolidated non-financial statement, I'll come back to that immediately, they also need to use the taxonomy. So where are we with this taxonomy? I think it's a very big step, but currently the taxonomy focuses really on the E. The only social element is that for an activity to be considered environmentally sustainable, it should be carried out in compliance with certain minimum social safeguards, but there is no separate idea of what is then social. That's only subject in the context of what is environmentally sustainable. And so to define those social safeguard references made to the OECD guidelines for multinational enterprises and UN guiding principles on business and human rights. So on the G then, the taxonomy doesn't say anything about governance sustainability. That doesn't mean that there isn't anything. We do have some initiatives already in the EU. We have the second version of the Shareholders' Rights Directive, which has a lot of provisions on stewardship, for instance, and trying to make increase shareholders' engagement. And there's also separate initiatives by the European Commission, who is expected to provide a proposal in regard of sustainable corporate governance in the second semester of this year. There's already a study out there which was made by Ernst & Young, but which is heavily criticized. I won't go into that. I have some PhD students working on that, but we don't have a taxonomy, even though there are some rules. And then the question will be, if you live up with those rules, will that mean that you are you have a sustainable government? Okay, so as I said, certain national labels are already transforming their label by using the taxonomy. But on top of that, the European Union is also working on an EU Ecolabel. Well, we already have an EU Ecolabel for green products, and then we're talking about all kinds of physical products. And now the European Commission wants to extend that Ecolabel to certain retail financial products. So there's certain criteria which are put out there, but it's still a proposal. I won't go into the details. If that Ecolabel comes into existence and will also apply to retail financial products, I must add to that it will only be just another label next to the national label. So it will not replace national labels. To know what is sustainable, as also mentioned by Professor Brakman, there's some other very important data providers. First are ESG ratings. We already know credit ratings for a very long time, and they are in the EU very heavily regulated. ESG ratings, and I've put some examples, FTSE Russell, MSCI, they are very important. Many investors rely on them, but for now they are not regulated nor supervised. But there again, change may come sooner, I hope soon, because ESMA, the European Securities and Markets Authority, has called for legislative action and has asked the European Commission to come up with a proposal to ensure quality and reliability of ESG ratings. On benchmarks, we already have a benchmark regulation since 2016, and that has been recently adapted in 2019 in order to adopt specific EU climate benchmarks. We have a climate transition benchmark and an EU Paris aligned benchmark. And on top of that, All other, even the non-climate benchmarks, all benchmarks should be transparent on how ESG factors are reflected in their benchmark. And by doing so, they obviously should then use the taxonomy again. A second pillar in the EU, that was the first pillar, what is sustainable, and the different actions the EU has taken in that regard. There's a second pillar, and that is how to provide sufficient ESG information to investors. And there I think that two initiatives are very important. The first is a non-financial reporting directive, which I already mentioned. The second is more novel, that's a disclosure regulation from 2019. The non-financial reporting directive is applicable to large companies with more than 500 employees. They are required to disclose reports on the policies they implement in relation to environmental protection, social responsibility and treatment of employees, respect for human rights, anti-corruption and bribery, diversity on company boards. So you see the three elements of ESG. Information needs to be disclosed in reports of those companies. What is then new after the action plan of the Commission is that until now companies had full flexibility on how to disclose this information. They could follow the guidelines of the UN Global Compact, OECD guidelines or other guidelines. Since 2019, the Commission has been working on uniformizing this information and creating an EU standard on how to report on ESG. A public consultation was launched last year, and we hope that the European Commission will come up with strict guidelines on that in the course of this year. Another important new regulation is the disclosure regulation, which comes up with certain important definitions. What is a sustainability risk? What is a sustainability factor? And what is a sustainable investment? And especially the last definition, I think, is very important. The disclosure regulation requires all financial markets participants and financial advisors to disclose on at an entity level how they position themselves in regard of sustainability, but also at product level. And they have to disclose information on all the products they have on offer. So as you can see in this slide, I hope it's big enough, this regulation has really a cross-sectoral scope of application. It applies to all financial market participants, be they investment funds or pension funds or portfolio managers or insurance firms. They all need to comply with this disclosure regulation. For financial advisors, the same is true. Both insurance advisors, credit institutions who provide investment advice, investment firms or investment funds providing advice, they all need to comply. And so the products in scope are also very broad. They are investment funds, but also pension products and portfolios which are managed for individual clients. They are also considered to be a financial product. So what do they need to disclose? Well, every financial market participant should disclose on its website its policies on how they integrate sustainability risk in their investment decision-making process and how they take into account adverse sustainability impacts of their investments, of their advice. Smaller financial market participants can say that they just don't take into account adverse sustainability impacts, but then they need to motivate why they don't. Large financial market participants are obliged to always take into account adverse sustainability impacts. They should also give information in their remuneration policy. How does the remuneration of their staff reflect these policies on sustainability? And also in pre-contractual information to their clients, they need to disclose how they integrate sustainability risks and how they deal with the results of the assessments of likely impacts of sustainability risk on the return of financial products. So that's a lot of information. On the product level, additional information should be disclosed. And I won't go into too many details here, but I just want to show you that there are actually two types of sustainable products. And we call them in Europe Article 9 and Article 8 products. The Article 9 products are the real sustainable products. They have sustainable investments as their objectives. For instance, shares in a company which has a windmill park. That is really a sustainable product. Article 9 products, they promote certain social or environmental characteristics, even though that is not really the goal of that company. And that is, again, for instance, that best-in-class strategy. Information on how they follow this objective, or how they want to reach this objective, or how they want to promote those characteristics should again be given in pre-contractual information and on the website. And moreover, in the periodic reports and on the website, you should also look back and see to what extent those characteristics or these objectives has actually been achieved or not. So that is also, I think, quite important. I would like to finalize with a final point on the role of financial intermediaries, which Professor Brakman also indicated is very important. Why is it so important? Because obviously those financial intermediaries, and I'm talking here again about advisors, portfolio managers, they give access to investors to sustainable finance. And here in literature, we have seen, and that's also thanks to Arnaud, who has done some research on this, that there's a value action gap. That means that there's a gap between investors' intentions on the one hand, and on the other hand, their investment behavior. Many investors, and especially many young people, they have very good intentions and they want a more sustainable world. And if then you compare that with how those investors invest, they will often still not invest in ESG products. The question is what the cause is. I haven't done any research on that myself, so what I'm telling you now is just relying on research of others. Causes are that there's a lack of knowledge by many investors on the availability of sustainable finance, or a lack of availability to court, that their banks are just not offering very many sustainable products, or a lack of trust. There's a perception among many people that those sustainable products will be less profitable or have more volatility. So what to do about this? Well, obviously part of the solution is disclosure. Information, and that I have already dealt with. But the European Commission and the European regulator is going further by including sustainability in its conduct of business rules framework. And that is a very important directive in Europe, the MiFID, which sets out rules of conduct for investment firms, investment advisors, etc. And so the most important rule here is the suitability test. And I guess a similar test also exists in the US. It requires an intermediary to ask from the client about their knowledge and experience, their financial situation, and their investment objectives. Until now, those investment objectives were only about financially. Do you want to only make profit, or what is your goal? Is it long-term? Is it short-term? Now, under the suitability test, it is not yet adopted, but it is close to adoption, a rule that you will also have to ask about ESG preferences from the client, so that you can not only match the right risk of the product with that client, but also the right ESG profile of a product with the right ESG profile of the client. And so their intermediaries will become very important again. The question has arisen, and the Commission has been consulting on that question, whether the legislator should go further still. because it is possible, it would be possible to, and you could call this a kind of nudging investors into ESG products. For instance, by if you have several products available with the same characteristics, you could, if you have several products available with the same characteristics, you could favor the ESG products and put that as a default option. This is obviously going quite far, but something similar exists already in EU law, where an investment advisor, if two products are more or less equivalent, has to advise the client to invest in the least costly or the least complex product. So something similar would be possible, but it is not yet law. To conclude, I think that the EU has taken very important steps already. Sustainable finance is a new objective of financial regulation and is at the basis of a fundamental reform of EU financial regulation today. Important steps have been taken in a remarkably short time frame with the Taxonomy Regulation, the Disclosure Regulation, non-financial reporting, which will be further standardized, the regulation of ESG benchmarks, and other pointed reforms. But still many challenges remain. As I said in the taxonomy, the S and the G remain underdeveloped. I think there's a need for increased comparability of labels as well. And there's a need for regulation and supervision of ESG ratings and data providers. And those aspects really need to be tackled to avoid greenwashing and to maintain investor confidence in ESG products. I would like to conclude with a quote I read just a month ago in the Financial Times. 2021 is likely to be the year that green meets Wall Street's greed and fear. So I hope that is true, and that I think with many of you being present today, showing a great interest in a sustainable, more sustainable world. So I think I have good hopes that what is stated here is indeed true. So thank you for giving me the floor, Arno.
Okay, thank you very much, Professor Colaert. I will now look at the audience. If you have any questions, you can raise your hand. You can also put them in the chat and then unmute yourself. I have received some questions via mail, so maybe I should ask those first. The first is for Professor Brakman. So in the SFDR, so the Sustainable Finance Disclosure Regulation, we've tried to make a difference between sustainable and non-sustainable investment funds and financial products. But then what we see is that in these regulations, these concepts that are used are also stretched to include as much as variety as possible. Is there any possibility for the regulator to create their strict delineation between what is sustainable and what is not sustainable?
That is totally
so I think it's possible to probably identify non-sustainable investment strategies. I think it's going to be more difficult to create a very uniform kind of bucket of sustainable investments. I think it's really a spectrum. And this is one of the reasons why disclosure is so challenging and why comparability is so difficult. So I think it will be necessary not to just create two categories, but to provide something more nuanced in order to really give investors the information they need. And also, I think the point that Professor Colaert mentioned is very important. You don't want to, I think, kind of tar companies that are doing the work of moving along that sustainability spectrum, but are not yet best in class with a kind of non-sustainable label that would remove the incentive for them to continue that work. So I think that's a really important dynamic to keep in mind, as regulators create these, efforts to inform investors.
Okay, thank you very much. I'll look again at the audience first before I ask the next question. Okay, it's again for you, Professor Brakman. You mentioned before the investment advisors regulation and the classification thereof. And we had a recent discussion about whether proxy advisors should be under the investment advisor regulation. And they pretty much use the same argument that the CRAs used during the financial crisis, which is we just give opinions and you can use them. And now you essentially made a similar argument about the benchmark providers. Should these in a way also be considered as investment advisors, or would that be a too strict regime? Or should there be adopted a new regime, and should that be based as well on certain mandatory criteria like we saw in the new two categories of benchmarks that have been created in the European Union?
It's possible.
Sorry. Yes. So I think the proxy advisor regulation in the US that has been quite controversial is a bit different from the question of regulating index providers as investment advisors. I do think there are some index products that really are investment advice. It's really just an investment company, which is an investment advisor, kind of farming out their or delegating their advising role to an index provider. And the most extreme case is when you have an index that's used for a single fund, right? So I think in that case, it makes sense to regulate what I think is the reality of what's happening, that the index is really advising on what is a good sustainable investment. On the other hand, you of course have indexes that are real indexes that are doing other work in the world, right? That are that would be appropriate to treat as publishers, right? And under the publisher exception that we have in the US. So I think it's, again, not a place where we can just have two categories. And instead, I think this is the reason why we've kind of sketched our thoughts around regulation of index providers, but are reserving space for kind of a more detailed discussion on that issue, which with the rise of passive investing goes far beyond this ESG category. I mean, passive investing is taking over our investment markets to such an enormous degree. It creates huge power, in the hands of those index and metric providers that fuel the passive fund creation and maintenance. So I don't think it's possible for those folks to continue to escape regulation with the way our market is transforming. And I think we definitely should look to what Europe has done in this area. I was very excited to hear about the new announcement in Professor Colaert's remarks, and we'll definitely be looking at that as we develop that new work. You guys are always ahead of us on this topic, as in many others.
I think that was a good addition on this topic, probably, yes, but not on many others.
Okay, thank you very much. Then I'll look once again if someone wants to ask a live question. Okay, then maybe a last one from my side. It's about politicalization of this entire process. Maybe for both of the speakers, first Professor Brakman, what we saw with the Department of Labor rules being going from the one end to the other, depending on the presidency in office. How do you see legal certainty created around ESG investment, especially in an area like pension funds, where it's especially important to have that legal certainty, and at least not being dependent on the presidency that is in office to take these ESG elements into account. And a similar thing we see in Europe right now with the Taxonomy Regulation, which is at this moment quite stuck. Once we go more in the technical details about natural gas, which should be included, which should not be included, and also very much member states in the European Union wanting to push forward their own agenda on that in that regard. So is there a way to make a distinction between politics and regulation on this side in order to create more credibility for the market?
So just on the U.S. example that you gave, it's very perceptive that this is a real problem, even if the Biden administration, as is expected, swings back in the other direction in terms of its guidance to pension fund managers. It's unlikely to for that alone to shift a lot of the behavior of those asset managers, because they are long-term investors, right? They don't want to be, in a situation in 4 years when we have a new president, perhaps, who would have a different view, right? And so although there have been many Democratic administrations over the period when this has been an issue that have provided, very generous guidance, giving opportunities for pension investors or investment managers to move in this direction, they've not done so. And I think they are inherently very conservative. And so you would need you will need more than just guidance from the Department of Labor on this that could shift with administrations. You would need more durable action along with that, such as legislation that would be much more difficult to dislodge. I do think the one other factor that is at work here is the convergence story. So, and again, the performance of ESG investments during the 2020 year and throughout the COVID-19 pandemic, I think is adding a lot of fuel to the argument that ESG performance is going to correlate positively with financial performance as opposed to detract from financial performance, and particularly is going to improve risk tolerance in investees. And if that's the case, then you may see movement not because of a political kind of view that aligns with sustainable investing goals or a strong concern about environmental protection, but instead just out of the financial goals and making sure that you maximize the pool of assets available for your pension beneficiaries. So if that kind of economic story continues to unfold in the way that it has been in the past few years, and it's certainly not clear that it will. There are some encouraging signs, but there are also holes in that story that suggest you can't have your cake and eat it too all the time. But if that economic story continues to unfold in that way, I think that could obviate some of the need for a strong political solution, which would be very difficult to forge in the U.S. environment, although I can't speak to the European context.
That's fair.
And especially with the ambition of the taxonomy regulation now to become really the framework of reference that we can have, would there be any feasibility in the US adopting that, or would we have to wait for the market to start to react on that and include them in their own products and then have this bottom-up growth of taxonomy application or some other taxonomy like the TCFD that exists? Or would we really,
I think you could see some impact here from the EU efforts in a similar way. I think about it with the data privacy changes that were enacted in the EU a couple of years ago. When you're talking about major players that are operating globally, as the biggest players in our investment markets are, and certainly if you're talking about regulation at the company level, our major multinational companies are, of course, operating at the global level. So you're going to see the ability of EU law to kind of force behavior that it wouldn't be efficient, right, to try to wall in only to apply to their activities in the EU. So I could imagine a situation developing where the taxonomy would, I find it hard to believe the US would just adopt the European taxonomy. I wish I lived in that US, but I don't. But I do think it's possible you could have that kind of ultimate effect, right? Like the old catalytic converter story. Once California said you had to have one, they just put it on all the cars because it wasn't worth figuring out which cars were going to California. So I think you could have a story like that in this area, but it will take a lot of time, and the EU would need to be a real leader and create systems that were workable, right, for those market players.
Okay, thank you very much. And maybe then to pick into the taxonomy itself. Now it's Professor Colaert, just a vocabulary people can use. Do you see that there are ways to make it more mandatory, or is there indeed need to have some consideration over the variations that exist? And then I think, for instance, about aligning the SFDR with the Taxonomy Regulation in Article 9 to make legal clarity about that, or do we take the decision of having these broad legal concepts and also including more variety into that?
Yeah, I think what the problem you mentioned is indeed an important one. We have, I think the EU has succeeded in making enormous steps and at a tremendous pace, but this is unfortunately not without shortcomings, because indeed there are some inconsistencies between, for instance, the taxonomy and the SFDR, which indeed need to be solved. And in my opinion, indeed, the disclosure regulation should be more aligned to the taxonomy. Yeah.
Okay, then I thank you very much. Then I once more look at the audience. You can also use the chat function. And if not, then the one thing I took away is that for once actually on the old continent we are leading in this agenda, but let's hope that there gets more index fund regulation. I saw one question that whether they can receive the PowerPoints. I look to the speakers whether that would be possible. In any event, we will record this session and we can send that to you as well. So there are increasing regulatory efforts. Most of the debate is unsettled, and I hope that we can eventually change the title of our webinar series by which means to whether we actually succeed or are able to no longer talk about the means but the actual results, and are able to assess that. I will like to use this last word to also promote our next upcoming event, which will be about the European climate law. And I'm sure that with the new administration, maybe the US will also, we can maybe also in a later stadium invite someone from the US, but now it's still with two KU Leuven professors, Professor De Ketelaere and Delbeke. So thank you very much for attending. Thank you very much, Professor Brakman.
Professor Brakman wants to ask a question. Or...
You're still muted.
I just wanted to ask Professor Colaert if you're aware of any empirical work on these issues, looking at investment firms operating in the EU, because it would be such an interesting comparison, as you shift the regulatory requirements to get that, empirical answer of whether it's working.
Yeah. As for now, I'm not aware of any empirical research going on. I should consult with my colleagues from the economics department, which are much more involved in empirical research, but I haven't seen anything published. That is why I was so happy to read your paper. And I think it would be very important to do something similar in the EU. And as you said, to make a comparison before and after the regulation. Maybe I should have added that all the regulations which I mentioned are just entering into force this year, or even later this year and next year. So it would be indeed very interesting to see what happens after that.
The first disclosures of the SFDR are already due on the 10th of March. So that's a very early deadline that we are now taking a look at. But maybe there's more empirical study possible once these